Thank you, everybody. Let's start with the second panel. I'll introduce myself, and then we'll have each of the panelists quickly do a short intro. My name is Adel Meer. I'm the Financial Sector Manager looking at financial inclusion at the IFC. Very happy to be here. And I thought the first panel kind of did half our work for us in terms of setting the stage. We've got a distinguished panel with us who are going to talk about their experience to date and what they've seen, what they are looking at in terms of coming down the pike, and a reflection of what's worked and what hasn't worked. Let me start by just saying that from our perspective at the IFC, we're always looking at good opportunities to invest. The fintech space has been a real game changer, at least for the financial sector. And as Sophie and the other panelists mentioned, we are learning from the changes that are occurring. There are certain successes and then there's certain failures. And the discussion we're going to have on the policy framework is really going to build on that learning. And I think the expectations that everyone has from the regulatory side, from the policy perspective, is that there's someone there to hold the basket when the chips start to fall. And that very often is the case, right? That's when people start focusing on policies and regulations, is when things go awry. But as though everything is bubbling well and things are going well, very few people worry about the guardrails. So it'll be good to get a view from the panelists in terms of what have they seen? Where have they seen that working, and where have they seen some of the shortcomings? So with that, let me pass it on to Julapa for you to just a short, brief intro, and then I'll ask each one of you the same question. If we were to apply the broader financial sector regulations pertaining to prudential and responsible lending and investing, would fintech investors and fintech innovators and embedded finance providers, and that's a realm we haven't really touched upon, would that limit innovation, or would that actually promote and create that ecosystem that drives both innovation but also financial consumer protection? Julapa.
Okay, you want just to introduce or just
introduce and
I'll talk about? Okay, so hi, my name is Julapa Jagtiani from Philadelphia Fed. I'm a senior economic advisor there. So I have to remind you that everything that I say today is my own views and not the view of the Federal Reserve Bank of Philadelphia or the Federal Reserve System. So my work has been, I'm an economist, but I'm in banking supervision department. So my work has been mostly on research related to fintech and financial innovations and how it impacts the banking safety and soundness and also consumer protection. I have gotten into this fintech topics almost 10 years ago. So I'm one of the first people in the Fed who actually start doing research on fintech and looking at alternative data and how it impacts financial inclusion. We have used unique data for this, but also because I am in supervision department, banks and the entire financial industry, it's basically they're just becoming more tech-oriented. Banks are becoming more tech-focused, and fintech actually many of them have become banks, right? So they got bank charters. So it's become kind of the line between the two have become blur over the years. But so we focus at the Fed. We supervise banks, we care about safety and soundness, consumer protection, and we want to know what the banks are doing, of course. And so I would start by saying that giving a basic fact, which you have heard from what happened around the globe. A lot of people don't have access to financial system or payment system around the globe. But you might be surprised that that's also happening in the US. Millions of people don't have bank accounts. Millions, 26 millions don't have credit score, have thin credit file or unscorable. And so they do have a problem getting access to credit. Now, for people who don't have bank accounts, why don't they have bank accounts? Some of them can't afford it because it's too expensive because of all the kind of fees, hidden fees, overdraft fees. And they don't have enough balance to maintain their minimum to avoid this monthly fees, for example. But beyond that, a lot of them actually don't want bank account because they don't trust banks, right? They choose to not have bank account. And so these people actually rely a lot on cash. And so as you heard before, you can't make payment to people far away or to your parents out of the country relying on just cash. So there's a role for stablecoin or CBDC to help them. But a lot of these people also don't have, even for people who have bank account, many of them can't access their earned income. So if the paycheck comes in on Friday, they need to spend on the weekend, but they can't access that cash until Monday. So fintech actually has come in to play a role to raise the bar for the banking industry. In fact, that many of the banks you have seen that they announced that now no more overdraft fees, and also more and more banks are allowing people to access their paycheck much sooner. So I think that does increase competition, and the partnership between the two also has really helped, because fintech lenders are subject to consumer protection regulation, but banks have depositors also, and so banks have to bank regulation. We have to protect not only consumers overall, but depositors and the financial system. So we don't want, as regulators, we don't want to see banks taking so much risk. And we don't want banks to give loan to all these people who are have low credit score, right? So, and also these people who have lower income and poor people, generally when they need a loan, it's smaller loan, which is more expensive to originate because there's a fixed cost to originate a loan. So for all these reasons, banks don't want to deal with poor people, right? So basically they are left behind. People who don't have bank account, people who are low income, low score, but there's a role for fintech to actually help close this gap by using alternative data is one thing that, but also more complex modeling. If you use more data, not the closest to data that is related to ability to pay may not be counted as traditional. For example, if you own a home, you pay for your mortgage regularly. You're building your credit history, and you're more likely to get credit because you are building you have higher credit score. But for people who don't have a home and they're all on time for the last 10 years paying their rent regularly, they're not building their credit score. And so that information, rent payment, could have been counted as something good that would enhance credit ability to access credit. So that is one of the alternative data. That so if you pay your utility or rent payment on time, even though you pay with cash, now there are vendors that provide utility payment and rent payment so that can be used for credit decision. That is the most basic thing. And the bank transactions, credit card transactions. But it could also be dangerous because some of these credit card transactions tells a lot about your entire life, right? So there's some story about if you use your credit card to pay for marriage counseling, they kind of know that you're going to probably get divorced, and so maybe likely that you won't get a loan, or maybe your house would go on the market, and if depends on the condition of the market. So all kinds of issues that may be violating consumer privacy. And also, once you share the data, you click on the box when you ask for a loan, and so the vendor actually go grab your data from the bank, merge it with credit card, merge it with all these other factors, your online footprint, your location, your social media, all kinds of information. So they know everything about you. And then we don't know if they're actually use it for something else or not. So there is more regulation that need to be in place to make sure that, yes, they're not supposed to do it, but how do we monitor to make sure that it's not being reused or used for other purposes.
Thank you. Thank you, Julapa. So over to you, Linda. I mean, now you've heard both sides, right? There's a need, but then there's an unmet demand, and there's regulations, and there's consumer protection. So in your experience, a little bit about where you're coming from and what are some of the trends you're seeing?
Well, first of all, thank you very much, Adel, for inviting me to speak and to join today. I have never been on Berkeley campus before. I'm just wowed by how beautiful it is. Georgetown is not this pretty, so. So I'm Linda Jeng. I recently founded my tech and policy advisory firm. We focus on Web3 startups. And before I began working in the blockchain sector, I was a financial regulator for 15 years. I actually focused most of my work on advanced economies. And when I was asked to speak on financial inclusion, I was like, oh, wow, this is not my main area of expertise. But then I realized all the work I've done actually have lessons for other countries. What we here in the US try to build, we have very much the same issues that other countries have. And so I very much want to spend a little bit of time talking about our experiences here in the US and how these lessons could be useful for improving financial inclusion globally. So before I get into it, I want to point out a very important statistic. And so that's why I have my phone out, because I want to make sure I have the numbers correct. So at the Fed, and actually I know Julapa well, we worked at the Fed together. I was at the Fed. I was also at the BIS. Like I was doing, central banking type work. And there we, it's about financial stability, it's about monetary policy. Rarely do we actually have to think about financial inclusion. It's actually not part of the mandate of the Federal Reserve. It's also not the part of the mandate of the OCC, which is about safety and soundness of banks, and is not the mandate of the FDIC, which is about the insurance of the bank deposits. So if you now take a step back and look at figures from the 2019 Fed report, the median net worth of typical white household is $188,200. This is 7.8 times greater than that of a Black household, which is only $24,100. This disparity is immense. And I'm bringing this figure up because we need to look at not only how can we use fintech, but also put into context with the political and historical path that led us to this terrible figure today. I'm not at the Fed anymore, so I'm free to say this, but systemic racism is deeply entrenched in our legal as well as our financial regulatory policies. And I'm from Washington, D.C., I'm based there. And after the Civil War, we had our first Black-owned bank. It was called Capital Savings Bank. It was opened in 1888. And by the time the Reconstruction era ended and shortly before a Great Depression era began, there were 130 Black-owned banks. Now, after the Great Depression, Congress felt there was a really important need to take into account how can we improve the financial system, how can we provide Americans with the ability to own homes and obtain the loans they need, et cetera. And so the Homeowners Loan Corporation, which we're not real, it doesn't exist anymore, it was created. And at that time, it refinanced over 1/10 of all US mortgages. But part of their work was to also create color-coded maps of over 200 cities in the US. And there they actually went into the microgeographic disparities and eventually ended up locking in those disparities. And at that time, the Federal Housing Administration was created, and it worked in tandem with the HOLC in in locking in the disparities in pricing discrimination and the redlining that we still see to this day. And so it wasn't until the civil rights movement that we have Congress passed the Fair Credit Housing Act, as well as the Equal Credit Opportunity Act. And those were passed in 1968 and 1974, respectively. But even with the passage of those two acts trying to remediate all the redlining, we still see these huge disparities today. So fast forward to today, in 2022, the FDIC in its latest report says that Black households have an unbanked rate of 11.3%, which what Julapa was just talking about earlier, compared to white households, which is only 2.1%. It just is, I have to say, it's embarrassing, and it's really truly pathetic. And so I can go on and on with more statistics about the disparities in, credit card rates and home ownership, et cetera. But now let's go back again to the figures of Black-owned banks. So minority deposit institutions are banks that are owned by 51% owned by people of color. And at this moment, we have around 148 MDIs. It's decreased since 186. They represent only 3% of all US banks and only 1% of US bank assets. But of all of these MDIs, only 22 are Black owned. And so I'm now curious, who here are students? All right, great. Who remembers how many banks were Black owned at the end of the Reconstruction era? 130. And today we only have 22. California, where we are right now, has actually the largest number of MDIs, but only one Black-owned bank. And studies have shown that Black-owned banks are more likely to provide loans to minorities. And here, I think, is a big problem in terms of what can we do policy-wise. So I've spoken quite a bit. I'm going to save the policy stuff so I can give Eric the chance to speak.
No, thank you. Thank you, Linda. And you raise a very valid point around marginalized populations and how policies can actually, the wrong policies can accentuate and make worse the existing disparity. Eric, thank you very much for joining. And with the IADB, you can bring the emerging markets sort of lens to this, because it's not just a US issue or a US specific issue. It happens across the globe, and it's probably even more prominent in many of the developing countries. So over to you, Eric.
Thank you, Adel. And this has been fantastic. I'm learning a lot. So my name is Eric Parrado. I'm the Chief Economist and General Manager of the Research Department at the Inter-American Development Bank. But I have to say that in my previous life, I used to be the chairman of the Banking Regulatory Agency in Chile. So I will try to defend the regulators. I will try. We have very specific regulatory objectives. We have a very specific perimeter of banks and financial institutions that we need to regulate. And this is enshrined in the law and regulations. We cannot do other things. We have to do those things. So when we talk about this tension between regulators and innovators, of course, we have different words. And when I have this discussion, I said, we are running different races. Regulators run the boring marathon, very constant, and the innovators run 100 meters. So we have to try to find a race in the middle, like 10K of half marathon. And then we're going to understand in terms that trying to regulate and supervise, but at the same time without stifling innovation. Okay. So for the regulator, it's very important solvency, liquidity, at least in the banking system. But the innovators don't care too much. Okay. So for instance, when I was there, when I entered in my first year, I believe in self-regulation. 4 years later, I said, no way. We have to regulate. And fintechs, they are trying to think with new ideas and so on, but you don't know if this is a good guy or a bad guy. So today, this morning, I went to the regulatory website in Chile, and I saw a really long list of fraudulent lenders, 144 in Chile, in a very well-run country, very well-regulated. They have good supervisors. But 144, they identified 144 fraudulent lenders. So imagine in other emerging market economies. So that's the problem. Having said that, of course, we have to improve rules, we have to improve laws. Otherwise, we have some, I would call it, creative destruction coming from politicians, because they have some ideas that look good in the paper, but they are not so good. Let me give you an example in terms of cap rates. Rates in Chile were really high, 60% in annual terms, or even 70% in annual terms. And then suddenly, a couple of politicians said, no, we have to cap this on behalf of the consumers. And then they cap it. But we insisted that this can create or could create an exclusion financially. And then there is a nice paper that we provide the data to do the analysis. And now one of the authors, I think, is in Yale University as a professor because of this project. And we saw a decrease, of course, of 9% in interest rates, and an exclusion of 19% of people. So that's why you need to think about new type of innovations in terms of trying to react beforehand. Otherwise, it's going to be really complex in terms of the political economy discussion. Another example. Somebody knows what is anatocism? If somebody knows, I pay you a dinner. But it's very simple. Anatocism is paying interest over interest. In economic terms, this is compound interest. Mm-hmm. So a couple of politicians said we need to ban anatocism. So we need to avoid this concept of compound interest. And I had to go to Congress to say, you know what? 1 plus R times K, one period, second period, 1 plus R times 1 plus R times K, and so on. So I said, if you ban this, it means that I'm not paying in deposit interest over your interest. They say, okay, I understand. But that's the problem, that we need to react before this overreaction. So I think that those are important examples. So on the positive side, and in my life, I always try to combine research and policy. Now we are trying to do a very nice research in terms of providing information to lenders to say in T-1, before getting a loan, we said a very simple message: compare. Go shopping. Go to several banks, other financial institutions, and just compare. And we have a treatment group and we have a control group. Then we are working with the regulator, so we know what are the conditions afterwards in terms of amounts, in terms of terms, and in terms of interest rates. So far in this simple pilot, we found that all all variables are the same with the control and the treatment, except the interest rates, which is lower for the treatment group. So we are not rationing credit, but on the contrary, we are providing more competition just with information. And if this is okay in terms of trying to finish this research, of course, it could be scalable to other countries and to other regions. So there is hope. Thank you very much.
Thank you, guys. And I think the conversation on top, I mean, what we just heard just shows us that there is a divergence. And it depends on where you are in that spectrum of development, in the governance and the independence of your regulator and the incentives of your policymakers, which really determine whether or not you want very intrusive policy interventions, or do you want a more detached, reactive solution? The way we've always looked at it is you've got to bucket it, you know? There is certain responsibilities that I think Eric and Julapa and Linda, you alluded to, that there's a fundamental responsibility to protect depositors, to protect the liquidity, to maintain some semblance of order when it comes to prudential regulations pertaining to public deposit-taking institutions. It gets fuzzier when it comes on the lending side. On the loan origination side, there doesn't seem to be that same level of focus on who can be given the lending license. And that's why you come up with your Chilean examples of 140, people that are not necessarily applying. On your depositor side, that list would be very, very short because there's a lot more tighter regulation. And I think we've got to think through both of those spectrums. We want stable financial institutions that encourage the savings element, because that's a very key component to financial inclusion, is promotion of savings and having trust in the financial sector. But then you want the options on the lending side, and you want the competitive pricing on the lending side. So let me start with the second round of questions, if I may. Julapa, in your research, you've done a lot of work around alternative data, AML, and how that enhances financial inclusion. Can you share a little bit on the summary of the results and the findings that you may have? And I understand it may be particular to the US, but I think a lot of countries look towards the US as the example case in the emerging markets, because your markets are deeper and more diverse than many of the emerging markets.
Sure. By the way, I thank you for having me. I didn't mention this when I was introduced myself. So that was what you just mentioned, the deposit, the protecting the financial system and depositor is on one side and protecting consumer is on the another side. And so it's a good segue to get into this bank fintech partnership, right? Because banks are getting low funding costs because deposits are mostly insured. And so that's why we don't want banks to take too much risk. And fintechs, on the other hand, don't have higher funding costs because they have to go either fund it themselves or securitize or just match investors and borrowers and take the fees. So partnership has been growing between banks and fintech, and more recent research shows that we look at partnership data and look at banks' origination of loans before and after, allowing for them to merge to implement the new technology using the fintech in the background, called white label. So we find that there is a positive impact for the lenders that we are looking, that given that more information and better modeling allow these lenders, banks, to have a more holistic picture about the person's financial life. So it's add a lot of color to just a credit score, right? And so they are more willing to offer loans to with a group of below prime, what we call below prime, a cut off a FICO score. Traditional score is 660 or 680. More probability of loan going to those people. And also for credit card, if we look at the mortgage loans, look at consumer loans, but for credit card, it's not the case because generally, as we know how we apply for credit card online. They just look at FICO score, right? And they ask for income, but they don't even verify it. So generally, it doesn't impact the probability of credit card going to below prime consumers. But given that they are slightly like borderline non-prime, we find that the total credit limit actually also increased after the fintech partnership. That means that banks, once they identify people, even based on the traditional FICO score, they are more willing to, they have more information and more willing to grant larger loans for both mortgage and credit card. And so this can be explained. My earlier research looked at the correlation between FICO score and the score that the fintech platform assigns to the same loan to the same person at the same time. And we find that the correlation could be as low as 30%, which means that a lot of information that the fintech lenders use could be coming from some other places that not in the FICO score. And so we also look further to follow some of these borrowers who we classify as below prime or non-prime, below 660 or below 680 FICO score. Just take those people and see if they actually default, right? Based on the rating grade that Lending Club assigns, A to G. And we find that for the same people below prime, or everyone is below prime. The ones that I assigned A and B rated actually did not default. And the ones that were assigned F and G actually default. And it's the same for high score people, like people who are 670 or higher. Some of them actually got the F and G as well, and they actually default. So it shows clearly how more information, better modeling actually help to, and it has a great potential to expand credit access. The problem is that with this fintech partnership, banks may not understand what they are doing. So that is the most concern that when we look at banks partner with these fintech platforms and they use all this additional data, and the solution comes from this black box. And they don't really understand what is inside this black box. So that is something that we need to, large banks are able to validate this. But smaller banks, community banks or credit unions have a harder time because they don't have enough resources to actually validate all these models on their own. So in terms of regulator, what to do? Regulators, something should be done to validate this upfront, because a lot of this actually 80% is the same across all these banks, how they use it, because the last 20%, the last marks is how they apply it in their infrastructure that they have to do on their own work. But 80% could be done upfront. And some of the credit union, for example, association actually have done some upfront validation to kind of, so if you want to do mortgage lending, so you can go with this. Or if you do consumer lending or the auto loan, there are some models already have been validated. And I think that would help a lot for smaller banks that need more help to access technology.
Thanks, Julapa. So more data does refine the model and build into that more sensible credit decision-making. Linda, I'll turn to you. On your side, what sort of policies and regulations do you think have had a significant impact on the financial inclusion landscape?
Yeah, so I want to connect what my prior remarks to what I'm about to speak on, which is I'm going to be focused on AML, but I really want to just tie together with what Julapa was saying. It's like, how can we improve financial inclusion? We also have to help make it less costly for banks and financial providers to provide services to those who are unbanked or underbanked. And I do think there's a role for capital liquidity rules. Like, for example, the Fed had launched some products called Bank On, and there are a bunch of, I think 48,000 bank accounts right now enrolled. And Bank On is just about having minimum balances, online payments. It is like minimum services, but very important services. So you can participate in the payment system and you can participate in online banking. And so it's these kind of products that actually speak and meet customer preferences that I think regulators should start thinking about. And if that is actually going to be useful for bringing in those who are financially excluded, we can think about what kind of capital requirements could actually encourage more banks to provide these types of products. The Credit Reinvestment Act also needs to be updated. It has not been touched since 1995. The banking agencies came out with their proposal last year. I have to confess, I don't understand their proposal. I think I've looked at it twice and I still don't get it. So, but it's very important to be able to give banks the opportunity to have economic incentives to put loans within, reinvest those loans within their community. And then very importantly, how to also provide more micro geographic data. So bank examiners can also be able to supervise at a much more granular level. And that's actually a Brookings point. And so Vice Chair Michael Barr from the Fed has raised some of these ideas, and I think we should definitely pursue them. And because these capital and liquidity rules, they don't think about financial inclusion. They're just about the safety and soundness of the banks. And that brings up another set of rules that probably are actually more expensive for the banks altogether, and those are anti-money laundering and counter-terrorist financing. These rules are probably the most costly for banks and also the least effective. And I'm saying this because annually, U.S. banks spend $50 billion on their AML compliance programs, but they're incredibly ineffective. The Basel Institute, using FATF data, came out with an effectiveness score of across all the jurisdictions of only 30%, which is pretty sad considering that we just spent $50 billion in the U.S. to prevent money laundering. $2 trillion in financial crime occurs in each year, but less than 1% are actually caught and stopped. And so what can we do to update our AML regime so it's less costly for banks, so banks can then be more inclined to bank the unbanked and underbanked who are not out to be laundering money, but they're considered to be too risky. And so there are actually a number of ways that can be done. First of all, the BSA AML regime here in the US really should be revamped to consider consumer data rights and consumer data protection. And once you ground those regulatory requirements in our right to be able to control our data, that means that we can also begin using privacy preserving technologies like self-managed identity solutions, zero knowledge proofs, multi-party computation, and then leveraging the blockchain, very transparent and immutable ledger, to do real-time surveillance of transactions. So it becomes more about risk-based approach about what the customer is actually doing, not who the customer is. And so these are very important principles that we need to go back to. And I feel sometimes when I say these things, I feel like I'm sounding very extreme, but this is in fact very much also the testimony that was given by my friend Greg Lisa, who was the former director of enforcement at FinCEN, and he just gave such testimony on Congress. So I hope all of you here will think about, wow, maybe it's time to update our regulatory regime to take into account our modern technologies.
Thank you, Linda. And I'm going to turn to you, Eric, but I know we don't have much time, but in our summary call, you talked a little bit about the fintech innovations that are happening in Latin America, one with a particular emphasis on gender. If you could just share your example with the room, that would be very good.
Perfect. Let me start with the good news in terms of the growth in digital payments in Latin America and the Caribbean. It has been impressive, and we are working with MasterCard. We had a partnership, and we are comparing on-sales transactions and in-person transactions, and internet transaction is very, very high. And when you compare with other regions, it's much higher than any other region. So this is good news. Also, in the good news bucket, we have Brazil Pix, Mexico CODIS, and there's a lot of transactions. We did a survey with Latin Barometer, and we found out that 60% of adults in Brazil use Pix, and for half of their transactions. So I think we have to find innovations in that regard in the digital payments. On the negative side, and thank you for your question, because we are almost there to publish this paper in a very good journal regarding the issue of discrimination against women in credit markets. And we hire actors and actresses to get loans with the same conditions, except that we have a group of men and we have a group of women. And we did that because we have raw data that says that women are better payers than men all the time, every time, despite the type of loan. But the interest rates were higher for women than men. And we said, okay, there is some evidence about biases or discrimination. So we did this exercise. We couldn't find that, but we found discriminations against women in terms of access. And the difference was huge. If you extrapolate, the foregone loans is around $12 billion just in Chile. So I'm saying, and I said to the banks, this is unfair, but also this is silly because you're losing money and you're leaving money on the table. So I think that the main message from us is trying to find more evidence and then trying to influence the policymaking process.
Thank you. We're out of time. So I'd like to thank Eric, Linda, and Julapa for joining me this afternoon. And all of you. This is the start of the conversation. As you heard from all of us and the panel before us, there's lots to be done, different models, different jurisdictions, different challenges. But I think we've got to work with industry and policymakers and regulators together to solve the universal challenge. Thank you very much.